Brian Tugin, back for this week's Markets in a Minute. We have a lot going on this week with the future Fed policy still a favorite topic, stubbornly high long-term Treasury yields, and growing concerns about inflation and the consumer top of mind. Plus, a few signals emerging from Treasuries and precious metals that could point to a potential policy error. Let's get into it. The Fed minutes were a key focus, with investors looking for clues on the path of interest rates. The crux is the collision of softer economic data with energy prices that, even at levels lower than a few months ago, remain 50% above year-ago levels. We have yet to see significant energy inflation cross over into other goods, but if markets begin viewing the Iran conflict as another lingering war, that could change. On the fiscal side, the biggest surprise came from the Treasury Department, which announced it would at least double purchases of longer-dated Treasuries, increasing individual buybacks from $2 billion to at least $4 billion. The move came after the 30-year yield hit its highest level since 2007. Yields immediately moved lower and stocks stabilized, although the impact may be temporary given the size of the Treasury market and the ongoing fiscal concerns. Treasury officials emphasized this was a liquidity measure, not a return to quantitative easing. So on one hand, you have a Fed trying to remain tough on inflation, while tariff refunds and fiscal policy potentially add fuel to the fire. Now for the mixed signal. Normally, gold and treasuries tend to move in opposite directions. When yields rise, non-yielding gold becomes less attractive, and vice versa. That didn't happen this week. Both rallied together, which could be an important signal. Investors may no longer view gold simply as an inflation hedge. Increasingly, it appears to be a hedge against fiscal risk, dollar weakness, and uncertainty around government debt management. This could be the most important development of the week. If long Treasury yields fall, but gold continues rising and the dollar weakens, that's more concerning than bonds simply rallying. The market may be saying, we like bonds if you're going to press down on yields, but don't trust the currency or fiscal trajectory. Finally, Moderna was the big equity market mover, with shares surging roughly 177% after Moderna and Merck reported encouraging results from their personalized melanoma vaccine program. That's going to be it for this week. Looking ahead, we have a spicy one. We will get NVIDIA earnings, Fed's Jackson Hole Symposium, and the release of Q2 GDP. Thank you for watching the latest Markets in a Minute. If you enjoy the video, please like, share, and subscribe to get notifications for the latest video content from iCM. I hope you have a great week, and I'll see you next Monday.